Hello and welcome to today's session on Term 100. Now you'll notice that the terminology that we're using here is a little bit strange in that it is term insurance, and as all you know, term insurance has an expiry date. So basically one of the issues with term insurance is that you have a beginning, but you also have a definitive end. So if you only bought it for 30 years, at the end of 30 years, if you didn't die, obviously, the policy expires and everything. So it is term insurance, but it also, if you notice, is to age 100. In other words, in this case here, it really becomes permanent insurance. That's really what it is. So basically, when you look at term insurance, it's all term to 100. It's sort of a hybrid between term insurance, but the problem is, of course, it has an expiry date, but also permanent insurance, which doesn't have an expiry date. However, it is sort of a hybrid of the two. So as you'll see, this particular product has a very specific use in when we call the estate planning process and everything else. So let's get ourselves started, and you'll see where I'm coming from on this. Okay. So the objective today is, of course, to talk about what is Term 100. What does it stand for? What's the difference, like I said, between regular everyday term insurance with permanent insurance? And we'll talk about, of course, how we use it for estate purposes, which is, of course, joint bonds to die type of policies and everything else. Okay, so these are objectives that we're going to be looking at. So what is Term to 100? First of all, the T100 or Term to 100 T100, basically, you might say it's a misnomer because this does fall under permanent insurance, and yet term insurance, of course, has an expiry date. So like I said before, it's somewhat of a hybrid between permanent and temporary insurance. Okay, so basically the idea of Term to 100 is that while it looks like term insurance because it has no cash value, it's got no dividends, it's got nothing, basically it's completely stripped down. At the same time, it does cover you for the rest of your life. Okay, so here you have a name that's designed basically years ago when people did not really, live to age 100. In other words, we didn't expect people to live to age 100. So this sort of the name stuck, you might say, but the reality is it is coverage for the rest of your life. Okay, so it is permanent insurance, just like whole life, par, non-par, that kind of stuff there. Okay, so it is basically coverage that has no real expiry date. Okay, so when we look at Term to 100 versus term insurance, okay, the difference between the Term 100, universal life, and term insurance product is that term insurance has that expiry date. And that's the main thing I want to stress to you, is that term insurance itself, in its raw form, basically does have an expiry date. Okay, universal life, okay, is permanent insurance, but it is going to be more expensive. Whole life is permanent insurance, par or non-par, but again, it's more expensive. So the client is basically saying, I like the fact that term insurance because it's relatively inexpensive, but I don't like the idea that it expires. I like the fact that universal life or whole life, par or non-par, doesn't expire, but it's also more expensive. What have you got for me? Sort of in between, you might say, have you got something that I can use for to mitigate issues for my estate, as you'll see shortly. Okay, so therefore, what have you got? So Term 100, as I said earlier, very much basically it's you might say a hybrid. Okay. So look at who actually buys it. Let's say all I really want is coverage for the rest of my life. I'm not interested in cash values and or saving a whole bunch of money, and not interested in tax sheltering. What I need is coverage that will make sure that there's enough liquidity in my estate so that all the bills can be paid. And that's the real purpose of T100 right there in a nutshell. In other words, the client we're going to be dealing with is going to be older clients, essentially people in their 60s, 70s, and all that, even in their 80s, okay, who are basically saying is, I already have an investment portfolio. I already have property. I already have all these things here. So I don't really need whole life. I really don't need universal life with all the bells and whistles the universal life come with, basically. What I need is raw insurance, but I don't want it to expire, okay? In other words, I need it for the rest of my life. In other words, basically the idea here is that I want coverage that will cover the capital gain taxes, funeral expenses, anything at all that's left when I pass away. Basically, that's the purpose of the. So in other words, T100 is really predominantly used for estate liquidation. That's the real thing, is that the client is basically saying is, I want to leave my estate to my children with no encumbrances against it. In other words, I don't want it to be sold or whatever it is. I want my grandchildren or my children to enjoy the property that I leave behind. Okay. So many people that do estate planning will recommend the T100, okay, because it's basically the ideal product, because it does design to provide liquidity for the estate, okay. So as I said earlier, you might look at T100 really as a hybrid between term insurance and permanent insurance, okay. It's that they basically is what it all comes down to, okay. However, while we call it term 100, it is basically, you might say misnomer, but it's sort of something between middle of the road pricing between inexpensive term insurance and more expensive permanent insurance, like whole life par, non-par, universal life, and everything. Okay. So, as we know, in Canada, you're deemed to dispose of all your worldly assets the day before you died at the fair market value. And that is a very strong basic tenet of the Income Tax Act, okay, is that you're deemed to dispose of all your worldly assets the day before you died at fair market value. So that basically means that at that point, all your taxes have to be paid up at that moment, essentially. And so now the question really comes down to is, where's this money going to come from in order for me to make sure that I have enough money so that the children don't have to sell the cottage in order to pay the taxes. In other words, I want to make sure that my kids will in fact get everything that I built. Now, the principal residence is the only thing that escapes this issue. Okay, in other words, your principal residence, we can only in Canada, you're only allowed to have one principal residence at a time. And so therefore, if you have a house, let's say in your respective jurisdiction, and you also have a cottage, only the house, for example, will be your principal residence. Cottage will be considered an investment. And so therefore, that will have some tax implications on that, okay? So basically what we're saying is that if you're going to leave your estate, let's say, to your children and everything else, okay, they have to have liquidity. They have to have cash in order to pay the taxes that are due at the time of death, okay? So a complication, as it says there, this creates for some, is that if the children do not have liquidity that will cover these taxes, they may end up having to sell part of the estate in order to cover those taxes. See, CRA doesn't really care where the money is coming from, obviously as long as it's legal, but it does care in terms of saying we want you to pay up your taxes, and that's all there's to it. So if the children don't have the liquidity to do that, then they're going to end up having to sell the cottage or whatever it is in order just to pay the taxes, and that sort of defeats the whole purpose of building an estate in the first place. Okay. There's only one exception to what I've just said, and that is that there is a spousal rollover. So in case of a spouse, your estate can roll over to your legally wed or common law partner. In other words, the only exception to what I've just said in terms that you're deemed to have disposed of all your worldly assets at the time of death is that if you have a spousal rollover. And remember that a spousal rollover doesn't necessarily mean that you don't have to pay any taxes. What it just means is that the taxes will be deferred until your spouse dies as well, in other words, upon the second death. Okay? So therefore, well, yes, I've disposed of my property, but because I have a spouse, so therefore, I can roll over that property to my spouse, and so therefore the tax will be deferred. Now notice I said the word deferred. In other words, not forgiven. All we're doing is delaying the inevitable further down the line, basically, okay? And so once again, how do we provide liquidity so that when my wife dies, let's say in my case, the children will have enough money to pay the taxes that are due and everything else, so that the cottage or whatever it is that we've got will not have to be sold. So term to 100 policy is designed to ensure that your estate gets transferred to the next generation with no tax implication or minimal tax implication. That's the main purpose of term to 100. So the end result, the purpose of it is to provide liquidity for the estate. That's the main thing. So premiums actually terminate at age 100. That's why we call it term to 100. In other words, the coverage will continue ongoing for as long as you live, but the premiums will stop at age 100. Now, you should refer to your company in terms of what happens at age 100. We do know that in all cases, the premiums do stop at age 100. That's a given. However, some companies will actually pay out the death benefit while you're still alive at age 100. Some companies will say, no, the premiums will stop. However, we will pay it out only when you pass away. And so therefore you could be 110 by the time it actually gets paid out. So once again, I ask that you look at your company and see what is the policy, the company policy in terms of payments at age 100. We do know the premiums stop in both cases, but some will pay out the death benefit while you're alive at age 100. And in other words, it matures. Or some will say, no, we're not going to pay out until you actually pass away. So once again, take a look at your company to see what exactly it is that the company does. One of the most comfortable ways of doing this kind of thing is what we call joint last survivor. So I will use myself as an example. I have a spouse, let's say, and so therefore, when I pass away, my wife will basically get my estate. So that's what they call that rollover. So therefore, the tax are deferred, as I was saying before. However, the issue now comes down to is what about when she dies? Where's the money going to come from? So rather than buy just term 100 on myself only, I could buy what's called a joint last survivor using term 100. So therefore, I die, nothing happens, okay? But the moment my wife dies, then that money will in fact be paid out to the children. And so therefore, it is paid out on the second to die. So as it says there, could be two people being insured under one contract, and that's called joint last survivor or joint last to die, whichever way you want to use the terminology. So one of the most common use of terms 100, first day before birth, is of course joint last to die, where the coverage is paid out when the last person dies. Remember that there is spousal rollover, but there's no children rollover, and that's what we're talking about here. So I die, my wife steps into my shoes, that's fine, but when she dies, there's no further rollover at that point. The taxes will become due at that point. So in other words, the coverage that goes to the named beneficiaries or the estate will be used to pay taxes due upon the death of the last person, basically. So here's a typical scenario. Let's say my wife and I will equally insure it for $500,000. Upon my death, my wife steps into my shoes, and therefore there are no tax implications because of spousal rollover provision. However, upon my wife's death, everything happens. The capital gains on the cottage, stock portfolio we have, any costs for estate, liquidity, all of these costs are to be paid after the last person dies. So the term 100 policy will mitigate any taxes, any capital gain taxes, any income taxes, funeral expenses, etc., that are due at that point. In other words, what are the expenses at death, basically? The money could be used to pay off all those expenses, and therefore the property can be transferred over in a most tax-efficient way. So this allows basically to make sure that the estate actually gets transferred down from us, in other words, my wife and I, parents, to our children in a most tax-efficient manner possible. So they don't have to worry about liquidating the estate in order to pay their taxes. The insurance money will be used for that for that purpose. Okay. So to summarize all this, the student should know, basically. So you as a student should know the answer to the question when preparing for the LQP exam. His question is really simple: what is the most common use for term 100? And the answer is really quite simple: estate liquidity. So on the exam, and you will get definitely a question on the exam, and it will, if you see the word capital gain, or if you see the word estate, or anything along that line, and the question then will say, what product would you recommend? The answer is term 100. And if it's a husband and wife type of situation, a spousal situation, how would you set it up? It would be set up as a joint last to die policy. Okay? Because that spousal rollover is what we're talking about. Okay. So remember that all the questions on the exam will always be case study type questions. So therefore, they will paint you some kind of a picture, basically, and they will say, here's what's going on. These are the estate issues and everything, and what do you recommend? So they could go and say, what product is it that you recommend? T100 is the best product. On the exam, it will say universal life, they'll say whole life par, they'll say whole life non-par, they'll say all that. And those are all fine because they're permanent insurance as well. However, the best answer, remember, for multiple choice questions, is always the best answer. The best answer is, in this case here, because it's an estate issue, it's a capital gain issue, okay, is T100. And then if it is a husband and wife, in other words, Mr. and Mrs. Jones, then immediately that should trigger that what is necessary is T100, but it could be issued on a joint last survivor basis, okay? And that creates an important consideration for estate purposes. So that summarizes basically today's lesson, and we will see you next time.